stop what you are doing right now, because what you are about to hear could save you hundreds or even thousands of dollars on your next tax return. If you are 65 or older and you filed your taxes this year without knowing about these 5 special IRS tax breaks specifically designed for retirees, there is a very real chance you left a significant amount of your own hard-earned money sitting on the table. Millions of American seniors overpay their taxes every single year. Not because they are dishonest, not because they are careless, but because they simply were never told about the special provisions the IRS has put in place for people who are 65 and older. These are not loopholes. These are legitimate legal tax breaks written directly into the tax code, and they exist specifically to help people like you keep more of your retirement income, protect your Social Security benefits, and make your savings stretch a little further. Every taxpayer in the United States gets what is called a standard deduction, a set amount of income that is not taxed. For the 2024 tax year, a single filer gets a standard deduction of $14,600. But if you are 65 or older, the IRS gives you an additional amount on top of that. For a single filer who is 65 or older, that standard deduction jumps by $1,950, bringing your total to $16,550. Now, if you are married filing jointly, and both you and your spouse are 65 or older, each of you gets that additional amount, adding $3,100 total to your standard deduction. That means a married couple, both over 65, could be looking at a combined standard deduction of $30,700 for the 2024 tax year. What does that mean in practical terms? It means a larger portion of your income is completely shielded from federal income tax. It means your taxable income drops, which means your tax bill drops. The second break involves something called the medical expense deduction, and for seniors, this one is a game changer. Under IRS rules, if your qualified medical expenses exceed 7.5% of your adjusted gross income, you can deduct the amount above that threshold from your taxable income. Now, for a 40-year-old who is healthy and earning a 6-figure salary, this threshold can be very hard to reach. But for someone who is retired and living on a fixed income, and who has real medical costs, prescriptions, Medicare premiums, dental work, vision care, hearing aids, long-term care insurance, hospital visits, this threshold becomes very reachable. Let's put some real numbers to this. Suppose your adjusted gross income is $30,000 per year. 7.5% of $30,000 is $2,250. So if your total qualifying medical expenses for the year exceed $2,250, every single dollar above that amount can be deducted. If you spent $8,000 on medical costs, you could potentially deduct $5,750 from your taxable income. That is not a small number. That is real money going back into your pocket rather than going to Washington. And here is where people make a costly mistake. They do not keep track of their medical receipts throughout the year. They toss them out. They forget. And then at tax time, they have nothing to show for thousands of dollars in legitimate expenses. If you take nothing else from this video, please start keeping every medical receipt, every explanation of benefits from your insurance company, every Medicare statement, every pharmacy receipt. Put them in a folder, a shoebox, a drawer. It does not matter. Just keep them together, because they could be worth far more than you realize. Now, before we get to the third tax break, which is one that directly affects how your Social Security benefits are taxed, and trust me, you do not want to miss this one, I want to take just a moment to ask you something. If you have found this information useful so far, if you feel like this is exactly the kind of content that every retiree and senior in America should be watching, please take a second right now to hit that like button and subscribe to this channel. We put out videos every week covering IRS updates, Social Security changes, Medicare rules, retirement income strategies, and everything else that affects the financial lives of seniors across this country. Subscribing is completely free, and it ensures that every time we release a new video with information that could affect your money, it shows up right in your feed so you never miss out. The third tax break has to do with Social Security income, and this is where things get a little complicated. But stick with us, because understanding this could literally change the way you plan your entire retirement income strategy. Here is the truth that a lot of people do not know. Your Social Security benefits may not be fully taxable. In fact, depending on your combined income, which the IRS calls your provisional income, you may only owe taxes on a portion of your benefits, or you may owe nothing at all on them. Here is how the formula works. The IRS takes your adjusted gross income, adds any non-taxable interest you earned, and then adds half of your Social Security benefits. That total is your provisional income. If that number comes in below $25,000 for a single filer, or below $32,000 for a married couple filing jointly, none of your Social Security benefits are taxable. 0. If your provisional income falls between $25,000 and $34,000 as a single filer, up to 50% of your benefits may be taxable. And if it goes above $34,000, up to 85% may be taxable. Notice we said up to. Oh, that is important. The percentage that is actually taxable depends on your specific numbers, and there is real planning you can do to keep that number lower. For example, carefully managing when you take withdrawals from retirement accounts, how much interest income you report, and whether you use tax-free sources of income, like Roth IRA distributions, can all influence how much of your Social Security gets taxed. This is why tax planning in retirement is not a one-time event. It is something you should be revisiting every single year, and ideally before the tax year ends so you still have time to make adjustments. The fourth tax break on our list today is one that is incredibly valuable and yet consistently overlooked by seniors filing their own taxes, and that is the credit for the elderly or the disabled. This is an actual tax credit, not just a deduction, and the difference matters enormously. A deduction reduces the amount of your income that gets taxed. A credit, on the other hand, reduces your actual tax bill dollar for dollar. The credit for the elderly or the disabled is available to people who are 65 or older, or who are permanently and totally disabled and receive taxable disability income. The credit can be worth anywhere from a few $100s up to $1,125 depending on your filing status and income level. To qualify, your adjusted gross income has to fall below certain limits. $17,500 for single filers, $25,000 for married filing jointly when both spouses qualify, and $20,000 for married filing jointly when only one spouse qualifies. There are also non-taxable income limits that factor in. Now, this credit is not available to people at higher income levels, which is precisely why it is designed for seniors living on more modest retirement incomes. But here is the heartbreaking reality. A study found that a significant number of eligible seniors never claim this credit. They either do not know it exists or they assume their tax software or preparer handled it, when in fact it was overlooked. If you have never heard of this credit before today, you could be among the many seniors who have been leaving this money unclaimed for years. The fifth and final tax break we are covering today may be the most powerful one for people who are charitably inclined, and it is called the Qualified Charitable Distribution, or QCD. If you are 70 and a half or older and you have a traditional IRA, this strategy allows you to donate up to $105,000 per year. That is the 2024 limit, or directly from your IRA to a qualified charity, and that money is completely excluded from your taxable income. Not deducted, excluded. It never even shows up as income in the first place. Now you might be wondering why that matters. Here is why. After age 73, the IRS requires you to take what are called required minimum distributions, RMDs, and from your traditional IRA every single year, whether you need the money or not. These distributions are counted as ordinary income, which means they can push you into a higher tax bracket, increase how much of your Social Security is taxable, and even trigger higher Medicare Part B and Part D premiums through something called IRMAA, the Income-Related Monthly Adjustment Amount. That last point is one that catches many retirees completely off guard. They take their required minimum distribution, their income spikes for that year, and suddenly they are paying dramatically higher Medicare premiums the following year. It is a ripple effect that can cost thousands of dollars across multiple areas of their budget. The QCD is one of the most powerful tools available to counteract this effect. If you were going to donate to your church, your local food bank, a veterans organisation, or any other qualified 501, C3 charity anyway, routing that donation through a QCD from your IRA is almost always the smarter move from a tax perspective. The charity gets the same amount, but you get to reduce or even eliminate your taxable RMD, potentially keeping your income lower, your Medicare premiums lower, and your overall tax bill lower all at once. Now let's bring all of this together, because the real power here is not in knowing about any single one of these tax breaks in isolation. It is in understanding how they can work together as part of a coordinated strategy to protect your retirement income. Think about it this way. You use your higher standard deduction as your foundation. You keep every medical receipt and potentially deduct a significant portion of your healthcare costs. You plan your withdrawal strategy carefully to minimize how much of your Social Security gets taxed. If your income qualifies, you claim the credit for the elderly or the disabled. And if you are over 70 and a half with an IRA, you use the QCD to make your charitable giving do double duty for you financially. Each of these steps builds on the other, and together they can result in a dramatically lower tax bill, or in many cases, no federal income tax owed at all on a modest retirement income. The tax code is not static, it changes. The IRS updates rules, adjusts thresholds for inflation, and Congress periodically passes new legislation that can affect every single one of the items we just discussed. The standard deduction amounts change every year. The QCD limit has been adjusted upward. RMD age rules change significantly with recent retirement legislation. What was true 2 years ago may not be true today, and what is true today may shift again by the time your next tax return is due. That is why staying informed is not optional, it is essential. If you are serious about protecting your retirement income, keeping more of your Social Security, avoiding unnecessary taxes, and making smart decisions with your money in your senior years, then subscribing to this channel is one of the smartest and most practical things you can do right now. It costs you nothing. It takes 5 seconds. And it means you will never be caught off guard by an IRS update, a Social Security rule change, or a Medicare regulation that could have a direct impact on your financial security. We cover these topics every week in clear, simple language because we believe every American senior deserves to know exactly what they are entitled to and exactly how to claim it. Hit that subscribe button, turn on notifications so you never miss an update, and share this video with someone you care about, a spouse, a sibling, a friend, a neighbour. Because there is a very good chance they are missing out on these same tax breaks right now. Your financial future is worth protecting, and knowledge is the most powerful tool you have to do exactly that. We will see you in the next one.